So, hi, good afternoon. Today we are going to present the investment project of Blackrock. My name is Daniela Hernández, and my partners are Juan Sebastián Camelo and Andrés Julián García. So, the summary of content for this presentation is going to be the introduction, problem statement, summary literature review, the description of implemented models and analysis of results, conclusion, and finally, bibliography. So, the introduction. BlackRock is a company that specializes in making stock market investments in developing and established businesses. BlackRock this time intends to invest $1 million in three different businesses: Apple, eBay, and Coca-Cola. And this investment is done in order to maximize profit. BlackRock will invest based on one factor: annual yield or profit. However, we are going to mention data for risk with the help of the beta indicator that is going to give us an appetizer about the investment risk that runs when investing in these chosen companies. For the problem statement, the research question is, how could BlackRock maximize its profit by investing $1 million in three different companies? So here we can see that we have the decision variables: A, that is the quantity to invest in Apple; B, the quantity to invest in eBay; and C, the quantity to invest in Coca-Cola. The constraints are going to be that BlackRock should invest in company A more than 20% and less than 40%, in company B more than 20% and less than 50%, and in company C more than 30%. Additionally, the risk of investing in these three companies should be less than 0.05 or 5%. Now we have the beta indicator or risk, and this is due to the fact that the risk of investing should be lower than 5% because the policies of the company determine that. Now we have the annual yield, and these values of this indicator are also researched to know if the company has had a good earning in absolute values, and in this way we will know how much its shares have earned in the last year. And finally, we have here the objective function that was created with the profit values or the annual yields of the chosen companies multiplied by the decision variables.
Okay, perfect. So for the literature review, in this section, scientific research was made on which indicators should be considered to design an optimal investment portfolio. So we conducted a literature review of the following three concepts. First is the risk. The risk so that the investor can estimate all the events that may arise and that at any given time determined may hinder the financial goals that have been set. Number two, the yield curve. The yield curve it's fundamental for the transmission of monetary policy, a source of information on investors' expectations about future interest rates, could be economic growth, and of course, inflation. And finally, the number three is the profits when buying and selling shares. This is important for a business because profitability impacts whether a company can secure financial from a bank, attract investors to fund its operations, and grow its business. So we considered these three concepts that are really essential for situating research within the broader academic landscape, identifying research gaps, reporting methodology, and supporting the development of this particular case.
Now with the description of the implemented models, in this section we developed the model that was proposed at the beginning of the project using Solver, with decision variables, the chosen objective function, and the constraints established in the model. Considering that the solver performed tells us that we should invest as follows: Apple 20%, eBay 20%, and Coca-Cola 60%. The right return on investment will be 2.29% of the $1 million spread over the three companies. We got this result because Coca-Cola is the company with the highest return, and this will generate more profits to the company, and at the same time, the least risky. So in Apple and eBay, we will invest as little as possible.
Now let's talk a little bit about the experiments that we did, but we are going to explain the one from the sensitivity analysis due to the fact that the other experiments are well explained in the infographic. So here we have the sensibility analysis. And we are going to see what will happen if we play to increase or decrease the minimum investment in each company, and how this will affect our objective function or our returns. For the constrained minimum investment Apple equation, if we increment a 20% the minimum investment, we are going to have a reduction of the objective function or yield with a value of 1.82%. For the constrained minimum investment Apple equation, if we decrease a 20% the minimum investment, we are going to have an increase in the objective function or yield up to 2.76%. For the constrained minimum investment eBay equation, if we increase a 30% the minimum investment, we are going to have a reduction in the objective function or yield up to 2.07%. And for the constraint minimum investment eBay equation, if we decrease a 20% the minimum investment, we are going to have increase in the objective function or yield up to 2.43%. And finally, for the constraint minimum investment in Coca-Cola equation, if we increase a 30% the minimum investment here, we are going to have the same value in the objective function as in the original model, like is 2.29%.
Okay, now talking about the forecast of Apple, as the graph shows, there are two possible components. Stationary, because it moves as the closest point and does not move exaggeratedly. And trend, because it has a slope that has downward tendency. So the following model is made of the DES model, double exponential smoothing. Apple's return have a stationary component because the alpha of this model is almost 1, while beta, which represents, has 0. Furthermore, we can say that for December 2024, a return of 0.57% is predicted. The margin of error of MAPE of the prediction price is 0.108%.
Okay, perfect. So now for the forecasting of eBay, we can say that for this company, the method of triple exponential smoothing is used because of the historical data of eBay only recorded data up to 2019. So in the end of the forecast tell us the following, that this company has a movement or a mostly trend component as the beta, or in this case the trend, of the model gives us 1. Similarly, we can also see how alpha represents almost 1 stationary. So this means that this company has both a stationary component and a trend component. On the other hand, gamma or the seasonality component are not taken into account. So also we can see how the MAPE or margin of error is 1.01%, which is very low, and that for 2023 and 2024, a return of 2.13% and 2.19% respectively is expected. Well, and now the forecast of Coca-Cola. Here, as the graph shows, it does not show much of a trend actually. It is always in the range between 2.5 and 3.5, and this shows a stationary trend. Therefore, the method that is, though, the best to use in this case is DES, double exponential smoothing. So Coca-Cola returns have a stationary component because the alpha of this model is almost 1. Again, while beta, which represents the trend, has 0. Furthermore, we can say that for December 2024, a return of 2.95% is predicted. The margin of error, or MAPE, of the prediction price is 0.57%. So we can run the model, and it's very probable that the prediction of 2024 happens.
Now, the solver with forecast values as a final result by investing the values projected for 2024, taking into account the projections of the returns, we will obtain from that investment a return of 2.32%, when in 2023 our base model it was 2.29%.
So the main learning from doing this model was understanding how patterns and forecasts can be used in such an important area as stock market investing, and seeing how these models can actually work in real life. In conclusion, after doing many solvers and forecasting, the best decision in order to maximize profit is to invest 20% in Apple, 20% in eBay, and 60% in Coca-Cola, because like that, we are going to have a return of 2.32%. And all of this is proven with the results that the forecasting showed us. Also, since Coca-Cola is the least risky, it is more probable that we get these results. The forecast works because the approximation they give us is very accurate, and the trend line of the real data we have, and also the MAPE yields, were very small data that make the model work perfectly, and it estimates the real values as possible. Thank you so much.